Conditional orders may provide an alternative to investors who would like to add a layer of automation to the order entry process. This option is especially useful for those who may not log into their portfolio often to actively place orders. A conditional order has two or more parts that execute like a domino effect. The first part is the trigger, that first domino that falls to set off the sequence. In this video, we're learning about two types of conditional orders that relate to one another. One cancels other, and first triggers one cancels other. The names of these orders may sound somewhat intimidating, but once we go through some examples of some common cases, you'll hopefully see that it can be fairly straightforward. One cancels other can be a mouthful to say, so we sometimes refer to it as an OCO. Think of it as like a one or the other type of scenario. Like, you can either take a subway to work or you can drive your car to work. You can't do both, so only one of these can happen. One cancels other works the same way. There are two orders on the order entry ticket, and when it's sent to market, only one executes, not both. The remaining order automatically cancels. Why would an investor use this? One reason can be to help control new buy orders. For example, maybe you're interested in two similar companies, but you only have enough money to invest in one of them. Or maybe you don't want to take on risk by exposing your portfolio to more than one company from the same sector. If you use OCO, then you can include two buy orders for two different stocks on one ticket and know that only one of those orders will go through. You won't be stuck with both. A more common reason to use OCO is for exit strategies. This is when investors decide to sell off an investment, not buy or enter into one. For example, imagine you bought and own a stock, and you know that you want to sell it if it goes up to a certain price to take a potential profit, or down to a certain price with the aim of reducing a loss. You can't create two separate sell order tickets for the same stock because WebBroker will think you are duplicating an order. If WebBroker allowed both orders to go through, you could run the risk of overselling your position. This means selling more shares than you actually own when it may not have been your intention. So, to solve for this scenario, you can use OCO instead. Let's see how this plays out. In this example, you hold 100 shares of ABC1 stock, which you bought for $50 a share and is currently trading at the same price. If it goes up in price, great. That means you'll make a profit. On the other hand, if the stock goes down in price, which results in you losing money, then you may want to minimize that loss. Using OCO, you set your first order to sell your 100 shares at $60. This lets you exit with a profit of $10 or more per share. On your second order, you set it to sell on stop 100 shares at $40. This limits how much the stock needs to go down before you are willing to sell and accept a loss on the investment, but it also includes a goal of limiting any further dollar losses. We can look at the first order as Plan A and the second as Plan B. Ideally, you may want Plan A to happen, but Plan B is there to act as your safeguard if the investment doesn't work in your favor. Only one of these orders will get executed if the condition is met. It all depends on the movement of the stock price and if it will rise or fall to the prices you set. Now, what happens if you were to use this type of order to buy stock instead of sell? In this case, you may only want to buy stock if it drops to a certain price or if it rises to a certain price. A stock you're interested in might currently be $50 a share, but you may not want to buy it yet. You may only want to buy it when it drops to $45 a share or rises above $52. This means that in your first order, you set a limit to buy 100 shares at $45, and in your second order, you set a buy on stop at $52. Your buy order will go through once the stock reaches either one of these price points, canceling the other order. Let's create an OCO order on WebBroker. First, click the Buy Sell Quick Launch icon, then the Strategies tab. Select One Cancels Other. In the order ticket that comes up, you see there are two parts to it. Enter the details for your first order. With all conditional orders, the good till field must be the same for each order that makes up your strategy. Next, click to expand the second order and do the same in that one. Usually, investors enter a limit order on the first part and a stop market or stop limit on the second, but it's up to you. Notice the OR bracket on the left linking the two orders. This means either one of these orders can execute, but not both. Once you're done, preview and then send the order to market. When one fills, the other automatically cancels. Now that we've gone over one cancels other, let's look at how we can build onto this to create another type of conditional order. The next conditional order we're going over is called First Triggers One Cancels Other, or FTO. This order has three parts to it. Think of it like a hybrid between the OCO order and the One Triggers Another order, which is covered in a different video lesson. Like we just saw, a common example of when OCO may be used is to sell a stock or an ETF if it goes up or down to a specified price. But this means you must already own that stock. First Triggers OCO gives you an opportunity to buy the stock or ETF first if you don't already own it. Once the buy is filled, the OCO is automatically sent to the market. If one fills, then the other cancels. Let's see how this works. In this example, you want to buy 100 shares of stock at $20 and then sell the stock either when the stock rises to your target profit price or the stock falls to your stop loss price. You set the first part of your order entry ticket to buy 100 shares at $20. Then you set your second to sell 100 shares at a $30 limit and your third to sell on stop 100 shares at $10. This portion of the order remains dormant until the buy order gets executed. Once your first order executes and you buy 100 shares at $20, the second and third orders, which incorporates the OCO, will be activated. The OCO will only fill one of the two orders when their respective order condition is met. The other will cancel. On WebBroker, we set up this order in a similar way to how we set up other conditional orders. After you click the Buy, Sell, Quick Launch icon, select the Strategies tab and then First Triggers OCO. Fill in your details for the first order to buy the stock or ETF you want. Then, click to expand the second order and fill out a higher limit price to sell that same investment. In the third order, set a lower price to sell the stock or ETF using a stop market order or stop limit. Remember, with a stop market order, your order may sell at whatever the market price is at the time your stop price is triggered, so your fill price is uncertain. With a stop limit, you can specify the lowest price you are willing to sell at, but it may not execute if the price is falling quickly. You may also follow the arrow on the left to understand the sequence leading up to the OR sign, indicating the OCO part of the FTO order. Once you review your ticket and send it to the market, you wait. After the first part fills, the rest of your order is activated. Only one of the sell orders can fill and the other cancels. One cancels other and First Triggers One Cancels Other can help add some flexibility and control to your trades. And depending on your comfort level, they can be a good way to help avoid impulsive or spur-of-the-moment trading decisions that may be an emotional response to something sudden, like an increase in market volatility. One important point to keep in mind is that for the sake of simplicity, we do not include commissions or other fees in our examples. If you ever consider using these strategies, it is important to keep fees in mind when calculating your profit and losses on your investment strategies.